Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, November 18th. So by the way, I was on Pomp Podcast yesterday. Definitely go check that out. I thought that was one of the best interviews I did all year in terms of external media. Just kind of explaining some of the, where I think we are in this sort of broader bear market process, business cycle process. In layman's terms, without all the jargon and nomenclature and all the fancy charts that many folks have come to expect from me. But I spent some time this morning creating some more fancy charts, four of the most important fancy charts I have ever created in my career, because they were quite enlightening as it relates to sort of some of the key lessons that we all learned from with respect to the long-term debt cycle from our buddy Ray Dalio over there at Bridgewater, and applying some of those lessons to today. So just kind of piggybacking on some of the stuff I was discussing with Pomp and sort of embellishing on some of the work that we're doing here. Definitely subscribe to the Left Morning Note if you want to see those charts. But I'll just give you the quick summary, because it's not anything new and exciting relative to what we've been saying. But the key takeaways from this long-term debt cycle work that we just performed are as follows. As far back as we have the data, which goes back to 1948, the U.S. has never entered an actual recession with public debt growing faster than either household or corporate debt. Public debt is growing nearly twice as fast as debt in the private sector in the current juncture. The U.S. economy has never entered an actual recession with household debt growing as slowly as it has today. The U.S. economy has never entered an actual recession with corporate debt growing as slowly as it is today. The rapid expansion of the monetary base in 2020 to 2021, propagated by the most aggressive monetary easing we've ever seen out of the Federal Reserve, allowed for all that growth in government debt to be digested by financial markets well. The sharp slowdown in the growth of the monetary base since then, in the context of still rapid growth of public sector debt, has caused a significant amount of indigestion in financial markets. The U.S. has never seen a significant decline in inflation from an above trend level without a fiscal tightening, i.e. a significant deceleration in the year-over-year rate of change in public debt growth, or monetary tightening via positive real short-term interest rates. Neither precondition has been met at the current juncture. So definitely go check out that Leadoff Morning Note if you want to get the charts. You want to study the charts and kind of better understand some of these long-term and cyclical debt cycles. But as you can see by the key takeaways, we don't think we're anywhere close to recession. And as a function of not being anywhere close to recession, it's very unlikely that we see a substantial and persistent and accelerated and autocorrelated disinflation process. It's likely to be sticky and stochastic as long as the economy remains resilient, as supported by some of these cyclical and structural debt dynamics. But anyway, getting into my Longbow dashboard. Same setup as we've been talking about for the last few days. Everything's pretty much in the middle of the range with the exception of crude oil, which is oversold today. So crude oil oversold here. Right there at 81.64. So definitely be a spot to be thinking about getting longer of crude oil. We got the Russian, I wouldn't say crude oil ban is the wrong word. The price cap on Russian crude oil coming down the pike on December 5th. There's likely there's going to be some front running into that in the context of Russian barrels of crude not necessarily coming off the market, but being, the supply being sort of diverted elsewhere, India, China, and all the kind of consternation that's going to cause from a supply chain perspective. So it may feel like Russian barrels of crude oil are being taken off the market, if only temporarily. So this would be a good spot to be allocating to crude oil. And then just kind of just one thing, my general thoughts, as I mentioned, no real changes from a momentum or trading range perspective with respect to the dollar, gold, 10-year, S&P, VIX, NASDAQ, Russell, Bitcoin, Ethereum, Shanghai Composite, et cetera. So pretty much in a steady state. We have a $2.1 trillion OPEX expiring monthly option expiry today on Friday, November 18th. We'll see if markets unpin, if that allows markets to unpin and really start to flow in the direction that they really want to flow. Some people think that flow is going to be higher. Everyone's betting. There's a lot of folks betting on a Santa Claus rally. There's a lot of folks who saw that inflation print last Thursday and are effectively saying, "Hey, look, this is the new normal." And we're going to start to have more of a Goldilocks bent to asset markets. We're not in that camp. We definitely think there's going to be a big lump of coal headed our way for the month of December. We think markets, risk assets in particular, are likely to crash or feel like they're crashing in December before we probably give way to a much better trading environment in the first half of next year. But as I mentioned, first half of next year, that's probably 2 careers away from us. Let's just try to land the plane on 2022. Anyway, Getting to my free daily alpha tab where we sort 300 ETFs, all representing individual factor exposures by the odds column. That gives us an indication of what's most overbought. Nothing really overbought this morning. So we'll scroll down, find the most oversold signal, and that's Argentina. So don't cry for me, Argentina. But if you want to buy some EM exposure to set yourself up for next year, you want to start the down cost averaging into that stuff. This would certainly be one of those places if you're betting on a sustained dollar decline heading into next year. Again, not the best spot, in my opinion, to be buying Argentina, given what we think we know about December, but it is what it is. But again, different views make a market. We're not here to bludgeon you over the head and tell you what you need to do because we do a lot of research. I think I personally put out more research than anybody on Global Wall Street. I think that's a by country mile, actually. I think I put out more research than anybody on Global Wall Street. But just because we put out research doesn't mean you need to adopt and agree with our views. What we're trying to do is empower you as an investor with all these data, with all the tools to help make you make better decisions at various intervals in the macro cycle. That's all we're really trying to do. Make some friends along the way, and life is good. So appreciate you for tuning in. We'll catch you back here. Actually, I won't catch you back here next week. I will be off next week, all of next week, visiting my family back home in Seattle. So we will catch you back here the following week, I believe, on November 28th. Cheers. Oh, and happy Thanksgiving.